As the biopharmaceutical world faces these huge shifts, you have to ask, can a company like Amgen really outrun that looming patent cliff and, secure its next decade of growth?
Or is that tension between the future potential and these legacy challenges just too great? It's a tough one for investors to navigate confidently.
Exactly. That's the core question we're diving into today. Welcome to the deep dive.
This is where we take a whole stack of information, articles, research, notes, and really cut through the noise.
We want to give you the most important insights, those aha moments, so you walk away feeling like the most informed person in the room on what really matters. Today, we're setting our sights on Amgen Inc., ticker AMGN, a true heavyweight in the biotech space.
Yep, a giant.
We're looking at a pretty comprehensive analysis of the company as of June 20, 2025. The stock was priced around $289.33 then.
And our mission here is to really get under the hood, understand its business, the management, the financials, and crucially, its future prospects.
All through that lens of long-term value investing. It's a fascinating case study, especially in this industry that just moves so fast.
Absolutely. So we've structured this deep dive into two main parts just to give you a complete picture.
Right.
In part one, we'll really tackle Amgen's fundamental business, its leadership, who's steering the ship, and its financial health, the core numbers.
Right.
Then in part two, we'll zoom out a bit. We'll cover market sentiment, ownership, those key risks, and ultimately, what does all this mean for investors looking at the road ahead?
Sounds good. And hey, before we jump right in, just a quick note. If you're finding these deep dives valuable, and we hope you are, please remember to like this deep dive and subscribe to the Stock Analytics AI YouTube channel.
Yeah, it really helps us out.
It does. And for just €4.99 a month, members get priority deep dives on specific tickers. Plus, and this is exciting, over the next few months, we're covering all of the S&P 500 stocks exclusively for members.
Wow, all of them. That's a huge undertaking.
It's going to be incredible. A great resource to stay ahead of the curve.
Oh.
Okay, let's unpack this. We begin our deep dive with the very foundation of Amgen. Its business.
Let's do it.
All right, kicking off part one then. Let's jump straight into chapter one, business analysis.
Okay.
So the report we're digging into, it starts by posing that fundamental tension we just mentioned. Can Amgen's massive bet on its pipeline, plus those recent big acquisitions, can they truly secure the next decade of growth?
Or is it just destined to be held back by that, almost inevitable patent cliff? That question really defines the whole investment narrative here.
It really does. So let's
Yeah.
start with the basics. What is Amgen?
Right. So Amgen is a fully integrated global biopharmaceutical company established way back in 1980.
Okay.
Their core work involves discovering, developing, manufacturing, and commercializing innovative human therapeutics. It's all primarily leveraging cellular and molecular biology.
So think of them like a one-stop shop for these complex, often life-changing medicines.
Exactly. They handle the whole process.
So how do they actually make their money? Where's the revenue coming from?
It's predominantly through product sales of their biologic medicines. And just to clarify, biologics are those complex protein-based drugs derived from living organisms.
Right, distinct from your traditional chemical pills.
Yeah.
Much more complex to make.
Very much so. But they also have strategic collaborations, licensing agreements, and a really interesting and growing move into biosimilars.
Ah, the biosimilars. Those are the more affordable, sort of off-patent versions of biologics, right?
Precisely. And what's truly strategic about that, and what gives them this unique layer of resilience, is their dual approach.
How so?
Well, they're both an innovator, pushing out new cutting-edge drugs, and a biosimilar manufacturer.
Interesting.
It's almost like this internal shock absorber. The biosimilar arm can help secure a foundational revenue stream, even as their high-margin innovator drugs eventually face that patent expiry.
That makes a lot of sense, kind of hedging their bets internally. And speaking of products, they've certainly got some heavy hitters in their portfolio, don't they?
Oh yeah. In 2024, they boasted 14 blockbuster drugs. That means each one raking in over $1 billion in sales.
14. Wow. Any standouts?
Well, just to name a few, Prolia, that's for osteoporosis, brought in $4.0 billion. Repatha for cardiovascular disease, $2.2 billion. Otezla for inflammation, $2.1 billion.
Those are huge numbers.
And then you've got the impact of acquisitions. Their purchase of Horizon Therapeutics in late 2023 brought in Tepezza, a rare disease drug. That added another $1.9 billion to the top line right there.
So clearly a powerful portfolio.
Yeah.
If we zoom out a bit, where does Amgen sit in the broader industry picture?
Well, if we connect this to the bigger picture, Amgen is undeniably a blue-chip leader in this space.
Right.
They stand as one of the world's largest independent biotech companies. They employ about 24,000 people, presence in over 100 countries.
It's quite a footprint.
Definitely. Forbes ranked them hashtag 202 on its Global 2000 list. They're part of major indices like the Dow Jones and the S&P 500, and their market cap, as we said, hovers around $155.6 billion. They're a major player.
So, given all that scale and history, what truly defines their core value proposition? What are they promising to patients and the healthcare system?
It really boils down to transforming cutting-edge science into therapies that restore health or, even save lives.
Okay.
They have a sharp focus on innovative, highly differentiated medicines that provide large clinical benefits in addressing serious diseases.
So it's not just about any drug. It's about breakthrough therapies that make a real difference.
Exactly. That's the goal.
Now, this is a crucial factor for any investor looking at this space. The biopharmaceutical market itself, it's huge, isn't it?
Oh, absolutely massive. Over $450 billion in 2024 alone.
Wow.
And projected to reach over $1.4 trillion by the early 2030s.
Trillion? What on earth is fueling that kind of incredible growth?
Well, there are several key trends driving it. First, you've got the rising prevalence of chronic and rare diseases, partly because the global population is aging.
Makes sense.
Then there are just these incredible advancements in biotechnology itself. Things like genetic engineering, personalized medicine, constantly opening up new ways to treat diseases.
Right, the science is moving so fast.
And finally, there's significant expansion into emerging markets, opening up huge new patient populations.
But of course, it's not like they have this massive market all to themselves. It must be fiercely competitive.
Fierce is the right word. It's not a walk in the park at all. Amgen goes head-to-head, not just with those diversified pharmaceutical giants, Roche, Pfizer, J&J, Merck, AbbVie.
The big names.
Exactly. But also with highly specialized firms like Gilead Sciences and Vertex Pharmaceuticals. It's really a battle on multiple fronts.
Which brings up the whole regulatory side of things. How do they navigate that? It must be incredibly complex.
It is. The regulatory environment is incredibly stringent. We're talking complex, lengthy approval pathways. It can stretch over a decade and cost billions of dollars just to get one single drug to market. Manufacturing compliance is strictly enforced. Post-market surveillance is ongoing, rigorous. It's a tough environment.
Billions per drug. But I suppose there's an upside to those daunting challenges, right? For a company like Amgen anyway.
There absolutely is. They create massive barriers to entry for any potential newcomers.
Oh, so.
Well, think about it. Those prohibitive R&D costs, the average is now estimated at $2.6 billion per drug.
Wow.
Then you add those intense regulatory hurdles we just talked about, plus the robust intellectual property fortresses built around patents, and just the sheer scale and complexity required for manufacturing facilities for biologics.
So these factors act like a protective moat, basically, helping shield established players like Amgen from a flood of new competitors.
Precisely. It's a significant advantage. And speaking of advantages, Amgen has built a really powerful brand over its 4 decades.
Yeah, they're well known.
It's synonymous with cutting-edge biotech, scientific integrity. They've even been recognized by Time as one of the world's best companies and by Forbes as one of America's most just companies. That kind of reputation matters.
It certainly does. And their scale must give them cost advantages too, right?
Definitely. Their immense scale provides significant cost advantages. Take their next-gen manufacturing facility in Singapore, apparently. It was built in less than half the time and at a quarter of the cost of a traditional one.
That's impressive efficiency.
And that kind of efficiency translates directly to high operating margins, like that impressive 46.9% non-GAAP margin they posted in fiscal 2024.
Nearly 47% non-GAAP operating margin. That's very healthy.
Very. Now, it's not quite a traditional network effect, but Amgen benefits immensely from high switching costs for its biologic therapies.
Switching costs. Explain that.
Well, once a patient with a chronic condition is stable on a biologic medicine, doctors are often very reluctant to switch them to something else.
Why is that?
Concerns about clinical data consistency, maybe different safety profiles, or just their own familiarity with the drug they know works for that patient. Patients, too, often prefer not to switch if a treatment is working well.
Makes sense. Don't fix what isn't broken.
Exactly. And interestingly, some economic studies even suggest switching can paradoxically increase overall healthcare costs due to potential complications or needing more monitoring, so there's a real stickiness there.
Beyond that stickiness, what other unique assets do they have?
Well, their R&D pipeline is key. It's deep and diverse, with over 35 drug candidates in various stages right now.
35, okay.
They've got world-class expertise in biologics built up over 40 years, and they have a proven ability to execute major mergers and acquisitions and partnerships, like that huge $27.8 billion Horizon Therapeutics acquisition we mentioned.
Right, they clearly know how to put capital to work, both internally on R&D and externally through M&A.
Absolutely, which actually leads us nicely from the foundational business itself.
Yeah.
Let's shift focus to the people steering the ship. Let's talk about Chapter 2, Management Evaluation.
Okay, the leadership. So Robert Bradway has been CEO since 2012. What's his track record look like?
Pretty strong, actually. Under his leadership, Amgen delivered a 232% total shareholder return just between 2013 and 2023.
That's a solid return over a decade.
It is. He's also overseen a period of record revenue for the company and perhaps quite appealing to income investors, 13 consecutive years of dividend increases.
13 years straight. That shows commitment.
What's particularly noteworthy about his tenure, though, is his strategic response to that impending patent cliff we keep mentioning.
Right. How's he tackled that?
He's been quite aggressive, investing heavily in R&D, executing large-scale M&A like the Horizon deal specifically to plug future revenue gaps, and deliberately building out their biosimilar business as that internal hedge.
Proactive steps.
Very. And their disciplined approach to paying down the debt they took on for Horizon also demonstrates, I think, a strong sense of financial prudence. They didn't just take on debt without a clear plan to manage it.
And how are they on communication and ethics? That matters too.
Their communication transparency with investors seems notably high. They consistently provide detailed presentations, CEO letters. They lay things out.
Good.
Their ethical reputation is strong, recognized externally, and CEO Bradway generally maintains very positive employee ratings too. That kind of internal and external trust, well, it's invaluable, really.
Definitely builds confidence. So how does this leadership team allocate capital? Where are the dollars going?
Capital allocation under Bradway clearly prioritizes innovation. They poured a record $6.0 billion into R&D in 2024 alone.
$6 billion. That's a serious commitment to the pipeline.
It shows they aren't just trying to maintain the status quo. They're actively pushing boundaries to find the next big thing.
But it's not just R&D spending, is it? We mentioned that massive M&A.
Right. The $27.8 billion Horizon acquisition was a real game changer. It was very specifically aimed at acquiring high-growth, rare disease drugs.
Why rare diseases?
To strategically counter that looming patent cliff for their existing blockbusters like Prolia and Xgeva, it was a bold move.
But as you said, it came at the cost of a dramatically higher debt load. That's the trade-off investors need to watch closely.
Exactly. Which naturally leads us to an important question about their shareholder return strategy. How do they balance investment with returning cash to shareholders?
Yeah, especially with that dividend track record.
They maintain a very strong dividend policy. Those 13 consecutive years of increases are impressive. The 2025 annualized rate is expected to be $9.52 per share.
Okay. What about buybacks?
Interestingly, share buybacks have been halted for now. Management has been clear the priority is debt reduction post-Horizon.
Which generally long-term investors would probably appreciate, given the current balance sheet situation. Focus on strengthening the foundation.
Precisely. It's seen as a prudent move.
Let's unpack their return on invested capital, ROIC, because that's such a key measure of efficiency. How's that looking?
Right. For 2024, their ROIC stood at 8.91%.
8.91%. Now, how does that compare historically for Amgen?
Well, it's noticeably down from their historical mid to high double-digit figures.
So what does that dip really tell us?
It's a direct mathematical consequence of the massive Horizon acquisition, significantly increasing their total invested capital, the IC in ROIC.
Ah, okay. The denominator got much bigger overnight.
Exactly. So the success of that massive Horizon bet ultimately will be measured by whether that ROIC figure starts trending back up towards its historical levels over the next, say, 3 to 5 years as those acquired assets hopefully deliver strong earnings.
That's the key metric to watch then, going forward. All right, let's now dive deep into the numbers themselves. Chapter 3, financial analysis. We've talked business, we've talked leadership. Now for the figures that underpin it all.
Okay, the financials. As of that June 20, 2025 date, Amgen's market capitalization was approximately $155.6 billion. So a very substantial company, as we establish.
Indeed. And how's revenue growth looking? You mentioned Horizon helped.
It certainly has. Revenue growth has definitely been accelerating, particularly in 2023 and 2024 after that Horizon deal closed. They saw 19% overall growth in 2024,
19% is strong.
driven by a really powerful 23% increase in product volume. That kind of underlying volume growth is very significant. It's not just price increases.
Good point. What about profitability, those margins you mentioned earlier?
Yeah, their profit margins are pretty characteristic of a successful, mature biopharma company. Gross margin was 69.07%, operating margin 30.08%, net margin 17.39%.
Solid numbers.
And their non-GAAP operating margin, which adjusts for certain items to show core performance, was that impressive 46.9% in 2024 we talked about.
Right. And here's where it truly gets interesting, especially for value investors. Free cash flow. How's Amgen doing there?
Amgen is a prodigious cash generator, just a machine. They pulled in a staggering $10.4 billion in free cash flow in 2024 alone.
$10.4 billion.
Yeah. And that is the lifeblood that funds everything else, those dividends, the debt reduction efforts, future R&D. It's a very, very healthy cash flow picture.
That provides a lot of flexibility. What about earnings stability and growth?
They have a solid track record there, too. Yeah. Non-GAAP EPS grew 6% in 2024, 5% in 2023. And looking forward, management is projecting high single to low double-digit EPS growth through 2030.
Okay, so steady growth projected.
Which, if they achieve it, given the patent headwinds, would be a strong performance.
What about the balance sheet? That debt picture specifically.
Their debt-to-equity ratio is around 1.1, and S&P Global Ratings noted their adjusted debt to EBITDA was about 2.9 times as of March 2025.
Still elevated due to Horizon, presumably.
Exactly. It directly reflects the Horizon deal. And then that's why deleveraging is clearly stated as a top priority for management, hence that pause in share buybacks. They want to bring that ratio down.
Makes sense. Any concerns about short-term liquidity?
While a specific current ratio wasn't highlighted in this analysis, their strong cash position, about $8.8 billion on hand, plus that robust free cash flow generation we just discussed. It definitely suggests short-term liquidity isn't really a concern. They have plenty of operational flexibility.
Good to know. And for income investors, just to reiterate on the dividend.
It looks impeccable. Those 13 consecutive annual increases, combined with an A+ safety rating from some analysts, it really makes it a cornerstone for investors seeking consistent, reliable income.
Okay, that covers the health of the company. Now, the big question, valuation. How expensive is Amgen's stock right now?
Right, let's talk valuation. Amgen's trailing P/E ratio is about 26.2 times earnings. That's slightly above its 10-year historical average, which is around 24.5x.
So a little richer than its own history, but how does it stack up against competitors?
Well, compared to peers, it's definitely more expensive than some of the more mature, maybe slower growing companies like Biogen, which trades at about 12.6x P/E. But it's significantly cheaper than high-growth darlings like Eli Lilly, which is currently sitting at a sky-high 63.6x P/E, largely on the excitement around their own pipeline, especially in obesity.
Wow, quite a range there. What about forward PE looking ahead?
The forward PE, based on analyst estimates for next year's earnings, is around 14.0x.
14. That looks quite reasonable, actually. Almost suggests the market expects earnings to grow significantly to bring that multiple down from the trailing 26x.
It does imply expectations of decent earnings growth, yes.
So what does this all mean when we try to look beyond just these relative metrics? What about intrinsic value?
Right. Intrinsic valuation tries to determine the true underlying worth of a business based purely on its ability to generate cash in the future. The most common tool for this is a discounted cash flow, or DCF, analysis.
Explain DCF simply.
You basically project out all the cash flows you expect the company to generate in the future, and then you discount those future cash flows back to their present value using a discount rate that reflects the riskiness of those cash flows. Sum them up, and that's your estimated intrinsic value.
Okay, so has anyone run a DCF on Amgen recently?
Well, what's truly fascinating here is that one educational DCF model from Simply Walls actually estimates Amgen's fair value at a whopping $576.10 per share.
$576 compared to the current price, around $289. That is a massive difference.
It's a huge disparity, isn't it?
It really is, which of course raises a critical question. DCF models are notoriously sensitive to the assumptions you plug into them, right?
Highly sensitive. That's the crucial caveat. Key inputs are the future cash flow growth rate you assume and the discount rate you use.
And how do those inputs affect the outcome?
Simple relationship. A higher assumed growth rate leads to a much higher estimated value. Conversely, a higher discount rate which reflects more perceived risk or a higher required return, leads to a lower estimated value.
So that huge gap between the market price near $290 and that illustrative DCF value over $570. What does that tell us?
It tells us the market, through its current pricing, is implicitly baking in a far more pessimistic scenario for Amgen.
Pessimistic about what specifically?
Either about the potential success of its new pipeline, especially maritide and obesity, or perhaps assuming a much more severe negative impact from the upcoming patent cliff and new competition compared to whatever assumptions went into that particular DCF model.
Got it. So the core debate for an investor really boils down to whether the market is being overly pessimistic right now about those patent expirations and the execution risk around the pipeline. Is the glass half empty or potentially quite full?
That's exactly the crux of the investment decision here.
Okay. With that deep dive into Amgen's business, its management, and the financials, let's now broaden our view for part two. We need to look at market sentiment, ownership, and those critical risks.
Sounds good. Kicking off part two, we'll begin with chapter 4, market sentiment. How is the market feeling about Amgen right now?
Well, Wall Street analysts, broadly speaking, are generally quite positive. The consensus rating leans towards buy or outperform.
Okay, so the pros are generally favorable. What about price targets?
The average one-year price target seems to be hovering around $314 to $320. That suggests, what they believe is some modest upside from the current levels, around $290.
Modest upside. But is there agreement around that target?
That's where it gets interesting. What's really striking is the wide dispersion in those individual analyst targets. You see estimates as low as $185.
Wow, that's quite bearish.
And as high as $420.
That's a huge range. What does that tell you?
It truly indicates significant disagreement and uncertainty among the professionals who follow this stock closely.
And why such disagreement?
It's likely due to those conflicting forces we keep going back to. That promising, potentially massive pipeline on one hand versus those very real looming patent expirations on the other. It makes forecasting difficult, clearly.
Makes sense. What about recent news flow? Has it been positive or negative? Recent news seems to have maintained a tone of, let's say, cautious optimism.
Okay.
Positive progress in the pipeline. Things like new drug launches getting approved, and especially the advancement of their highly anticipated obesity candidate, maritide, into phase 3 trials. That's definitely viewed positive.
Phase 3 is a big step.
Huge. But that good news is clearly being balanced out by the ongoing discussions and analyst concerns around the Prolia patent cliff coming in 2025.
So a mix of good news on the future weighed against near-term challenges. What about market indicators? Short interest, technicals.
Looking at those, short interest is relatively low, about 2.41% of the float.
What does that mean?
It suggests that there aren't many large, high-conviction bearish bets being placed against the company right now. Not a lot of traders actively betting the price will fall significantly.
Okay, and technically, chart patterns.
Technically, Amgen's price did recently dip below its 50-day moving average, which some chart watchers see as indicating short-term negative momentum. And here's where it gets really interesting. For technical analysts, it actually crossed above its 200-day moving average back on June 16th, 2025.
And the 200-day is often seen as
a key indicator of the longer-term trend. Crossing above it can be interpreted as a bullish long-term signal.
So conflicting signals there, too, depending on whether you're looking short-term or long-term, seems to be a theme with Amgen right now.
It really does. Uncertainty is high.
Okay, next up, let's unpack Chapter 5, ownership structure. Who actually owns Amgen stock? Does it matter?
It definitely matters. Amgen stock is overwhelmingly owned by institutions, pension funds, mutual funds, hedge funds, etc.
Not much.
They account for approximately 81% of the outstanding shares, held by over 4,190 different institutional owners.
81%. So what are the implications of that?
Well, on one hand, it means that a lot of sophisticated smart money has vetted the company and decided to invest. That can be seen as a positive signal. But on the other hand, it also implies that large institutional buy or sell decisions can heavily influence the stock price, potentially more than retail investor sentiment. Big blocks moving can really swing things.
Got it. What about insiders? Management, directors, are they holding much stock?
Interestingly, insider holdings are quite low, just 0.45% of the company.
0.45%. That seems very low for a company this size. Any recent insider buying or selling?
Recent transactions show a slight negative tilt. There were 32 sell transactions versus 25 buy transactions in the last 3 months reported.
More selling than buying. Is that a red flag?
The net volume wasn't really substantial enough to be considered a major red flag, in my view. Insiders sell for many reasons, diversification, taxes, etc. But it's something to note, certainly not strong insider buying.
Okay. So summarizing ownership.
In summary, ownership is highly concentrated with professional money managers. They are the primary drivers of Amgen's stock price behavior on any given day based on their collective analysis and sentiment.
All right. Now, for a critical part of any investment thesis, Chapter 6, risk assessment. It's absolutely crucial to understand both the bright spots and the potential pitfalls here.
Couldn't agree more. Let's start with the strengths. Using a kind of SWOT analysis framework, Amgen boasts that strong, diverse portfolio with 14 blockbuster drugs currently.
Right, the billion-dollar club.
They have robust R&D capabilities and that deep pipeline with over 35 candidates we mentioned, excellent financial performance historically with high margins, and that impressive $10.4 billion in free cash flow in 2024.
Solid foundation.
And, of course, an established global presence with a powerful, recognized brand. Those are significant strengths.
Okay, clear strengths. Now, the flip side, the weaknesses. What are the biggest ones?
The most prominent weakness, without a doubt, is that high dependency on key products like Prolia and
Because of the patent cliff.
Exactly. They face patent expiry in 2025, potentially creating a substantial revenue hole that needs filling. Plus, that elevated debt from the Horizon acquisition, while manageable, does restrict financial flexibility in the near term.
Right, less room to maneuver.
And you also have some individual products already facing sales declines due to increasing competition, even before patent expiry.
Okay, those are significant headwinds. Let's move to opportunities. Where's the potential upside?
Well, the single largest growth opportunity, the one everyone is watching, is their potential entry into the absolutely massive obesity market with their candidate, Maritide.
If that hits big, it could be transformative.
Hugely transformative. There's also significant room for expansion of their biosimilars portfolio, capturing revenue as other companies' drugs go off patent. Geographic expansion into emerging markets is another avenue.
And sticking to their knitting.
Yes, continued growth in their existing high-value therapeutic areas like oncology and rare diseases, bolstered by the Horizon drugs. Plenty of opportunities.
All right. And finally, the threats. What keeps management and investors up at night?
The most acute threat is, again, that patent cliff for Prolia and Xgeva in 2025. That will invite biosimilar competition, putting direct pressure on sales and margins for those key products.
Unavoidable, really.
Pretty much. Beyond that, there's just intense overall competition across the entire biopharma industry. Persistent pricing pressure from governments and payers worldwide trying to control healthcare costs.
It's always a factor.
And then you have those broader macroeconomic and geopolitical factors to contend with.
Let's dig into those broader factors a bit. How does something like inflation affect Amgen?
Well, inflation directly impacts their cost structure. It drives up prices for active pharmaceutical ingredients, the key drug components, as well as other raw materials, energy, labor.
Squeezing margins, potentially?
Exactly, creating a potential margin squeeze if they can't pass those costs on fully. And higher interest rates, a big topic recently, increase the cost of servicing their significant debt load.
Makes that debt more expensive.
Yes. And it also raises the discount rate used in valuation models, which mathematically puts downward pressure on theoretical stock valuations.
Got it. What about specific geopolitical factors? Anything concrete there?
Yes. Things like the potential 2025 U.S. imposed tariffs on Chinese APIs, those could be up to 245%, according to some reports.
Wow, that's huge.
It is. And broader global tariffs in general. These things threaten to disrupt complex global supply chains, increase operational costs significantly, and could even invite retaliatory tariffs from other countries that might impact Amgen's international sales.
So a really complex global chessboard they're operating on, with risks coming from multiple angles.
Absolutely. It's not just about the science anymore.
Okay. So bringing it all together now, we arrive at Chapter 7, conclusion. Let's synthesize everything we've discussed into the core bull and bear arguments.
Sounds good. Let's start with the bull case.
Okay, the optimistic view. The bull case for Amgen really rests on it being a dominant, wide-moat business, excellent operational execution, shareholder-friendly management.
That strong dividend history.
Exactly. It's fundamentally a cash flow generating machine, proven over many years. And that deep pipeline, especially the potential blockbuster Maritide in obesity, coupled with the strategic Horizon acquisition. The bulls believe these can more than offset those patent cliff losses.
And the valuation argument.
And importantly, at its current valuation around $290, it appears reasonably priced, maybe even potentially undervalued, especially if you give credit to those more optimistic DCF models.
Okay, that's the bull case. Strong company, big potential, reasonable price. Now, the bearish side. What's the argument against Amgen?
On the bearish side, that near-term patent cliff for Prolia and Xgeva in 2025 is not theoretical. It poses a real significant risk of potentially billions in lost high-margin revenue, starting very soon.
A big hole to fill.
A very big hole. The Horizon acquisition, while strategically sound perhaps, undeniably added substantial debt, limiting their financial flexibility right when they might need it most.
And the pipeline isn't guaranteed.
Exactly. Success is heavily dependent on uncertain late-stage clinical trials. A major failure, particularly in the obesity program with Maritide, or even just stumbles in integrating Horizon smoothly, that could leave a significant revenue gap.
All while facing those other headwinds.
All while facing intense competition across the board, that persistent pricing pressure, plus those new geopolitical risks we just discussed. It's a challenging environment.
So, pulling that together on valuation again, what's the summary?
Well, the current market price, around $289 per share, it seems to reflect a rather cautious stance from investors. It acknowledges those very real patent cliff risks.
The market isn't ignoring the challenges.
No. But as we saw, those educational DCF models, which often build in more optimistic assumptions about pipeline success and growth, can estimate intrinsic values way up over $500 per share.
Right, that huge potential gap.
That wide gap really highlights the current market's conservative sentiment versus the company's underlying potential if things go right, particularly with that pipeline.
So what's the concluding outlook? Where does this leave investors?
Ultimately, at its current price, Amgen seems priced for moderate growth, with significant risks clearly acknowledged, baked into that price by the market.
Okay.
An investment in Amgen today, therefore, is really a bet. It's a bet that the market is currently underestimating its pipeline potential, particularly in that massive obesity market, and underestimating management's ability to successfully integrate Horizon and navigate this complex competitive landscape.
So a bet on execution and innovation potential.
Precisely. The bull case offers significant upside if these strategic bets pay off. But the bear case points to very real and substantial risks if they don't. Investors truly have to weigh Amgen's durable moat and its proven cash generation against these quite significant near-term uncertainties.
It's a classic risk-reward calculation.
It really is. And maybe, as you consider Amgen's future, you can ponder this. In an industry that's defined by both groundbreaking innovation and, frankly, rapid obsolescence, can a company truly transform its DNA quickly enough to turn a patent cliff from a major challenge into a springboard for its next golden age? It's a fascinating question.
A great question to end on. This was our deep dive into Amgen. If you found this valuable, please do like this deep dive and subscribe to the Stock Analytics AI YouTube channel.
Yeah, please do.
And remember, for just $4.99 a month, members get priority deep dives on specific tickers. Plus, we're covering all of the S&P 500 stocks exclusively for members over the next few months. It's a great offer.
It really is. And of course, here's the crucial disclaimer. This analysis was generated by an AI system purely for educational purposes. It should not be considered financial advice. Please, always conduct your own thorough research or consult with a qualified financial advisor before making any investment decisions.
Absolutely essential.
Thanks for diving deep with us today. Until next time, keep learning.